The coffee went cold 20 minutes ago and you have not noticed. You are sitting at the kitchen table, the same table where you have had 1,000 ordinary mornings, and you are holding a piece of paper that should feel like a finish line but instead feels like the beginning of something you are not sure you are ready for. It is your retirement account statement. The number on it is real. You spent decades building it. You did the right things mostly. You contributed, you waited, you resisted the urge to touch it when things got scary. And now here you are at 64 years old and the rules of the game have just quietly, completely changed. Because for 30 years the only job was to grow the pile, add to it, protect it, let it compound. You understood that game. But starting now and for every morning after this one, the job is something entirely different. Now you have to live off the pile. And nobody really prepared you for how different that feels, how much more fragile it suddenly seems. How a number that looked enormous in the accumulation phase somehow looks a lot smaller when you realize it has to last the rest of your life. That feeling sitting at that table with the cold coffee is not a weakness. It is not a sign you did something wrong. It is the feeling of someone standing at a real threshold, a genuine turning point, where the financial decisions you make in the next few years carry more weight than almost any decision you made in the decades before. And if you are anywhere near that table right now, this video is for you. If you are new here, subscribe right now because what we do on this channel is get into the psychology underneath the money. Not just the rules, but the reasons. I am David Marshall, and I have spent over a decade obsessed with the moments where financial decisions actually change the direction of someone's life. And what I want to share with you today is a simple, honest ETF strategy that more and more retirees are quietly using because they have figured out something that Wall Street marketing materials do not always make clear. That in retirement, simple is not just easier. Simple is often genuinely better. But before we get into the strategy itself, I need to tell you about a risk that most pre-retirees do not fully understand until it is too late to protect themselves from it. And once you understand it, the rest of this video will make complete sense. It is called sequence of returns risk, and here is how it works. Imagine two people who both retire with $1 million. Both of them experience the exact same average annual return over the next 20 years, on paper, identical outcomes. But one of them retires into a good market and one of them retires into a bad one. The person who retires into the good market sees their portfolio grow early, which means even when withdrawals start, they are pulling from a larger and still growing base. They are fine, likely more than fine. But the person who retires into a bad market, who experiences a significant crash in year 1 or year 2, is pulling withdrawals from a portfolio that is already shrinking. They are selling shares at low prices just to pay their bills. And those shares they sold at the bottom are gone. They cannot participate in the recovery. So even when the market eventually comes back, their portfolio is permanently smaller because of what happened in those early years. The average return ends up the same on paper, but the real-world outcome is completely different. One person runs out of money, the other does not. Same average returns, same starting balance, completely different lives. This is not a theoretical risk. This is the specific way retirement portfolios fail, and it is the most important thing to understand before you decide how to structure yours. This is exactly why the strategy we are going to talk about today is built the way it is. Because the entire architecture of it is designed around protecting you from this specific danger. And it does it without requiring you to be a sophisticated investor or spend your retirement watching financial news or paying someone a significant percentage of your savings to manage a complexity that may not even be serving you. The core of this strategy is what I call the two-bucket approach, and I want to be very clear that I am keeping this simple on purpose because simple is the point. The first bucket is a total market equity ETF. This is a single fund that owns a small piece of essentially every significant company in the United States stock market. When the economy grows over time, this bucket grows with it. This is your long-term engine. This is the part of your portfolio that fights inflation over a 20 or 30-year retirement, that gives your money a reason to keep growing after you stop working. You are not trying to pick winners. You are not making bets on sectors or trends. You own a small slice of all of it. And historically, over long periods, that has been one of the most reliable ways ordinary people have built and preserved real wealth. The second bucket is a high-quality bond ETF. Treasury bonds or investment-grade bonds, something stable and boring and not particularly exciting at a dinner party. This bucket is not here to make you rich. It is here to be steady when the first bucket is not. In years when the stock market drops and your equity ETF is down, you do not touch it. You live on your bond bucket. You give the equity side time to recover without being forced to sell at the worst possible moment. This is the direct defense against sequence of returns risk. You always have somewhere stable to pull from, so you never have to liquidate your growth assets during a downturn. Two buckets. One grows, one protects. You rebalance periodically when stocks have had a good run, moving some gains from the equity bucket into the bond bucket, which automatically forces you to do the one thing every investor knows they should do and almost nobody actually does consistently. You take a little off the table when things are up and you shore up your safety net. The structure does the discipline for you. Now I want to introduce you to what I call the spouse test. And this might be the most important idea in this entire video, even though it has nothing to do with tickers or percentages. Here is the test. If something happened to you tomorrow, could the person who loves you most look at your financial setup and understand what to do? Not with a finance degree, not after 6 months of research. On a hard day, when they are grieving, when they are overwhelmed, when they just need to know that the money is okay. Could they find it, understand it, and manage it without falling apart? If the answer is no, your portfolio is too complex. And I do not say that to criticize anyone. I say it because I have seen what happens to families when the financial complexity of a retirement portfolio becomes a crisis during an already difficult moment. There is a phrase I want you to hold on to. Complexity is anxiety wearing a suit. It looks impressive, it sounds sophisticated, but underneath it is often just unnecessary stress and exposure to mistakes. The two-bucket structure I just described passes the spouse test. Anyone can understand it. A total market fund and a bond fund. Pull from the stable one when you need cash. Let the growth one grow. Rebalance once a year. That is the whole thing. You could write that on an index card and leave it somewhere it would be found. That is the goal. Now there is one more piece of this strategy that could genuinely save you or your family tens of thousands of dollars over the course of your retirement, and it is almost never talked about in regular financial content. It is called a Roth conversion. Here is the setup. When you first retire, especially if you retire before Social Security kicks in or before required minimum distributions start, you may have a window of years where your taxable income is lower than it has been in decades. You are not working, you are not yet pulling from Social Security. You are living modestly off your savings or your bond bucket. And in those years, your tax bracket may drop significantly. That window is one of the most valuable financial opportunities most retirees never take advantage of. Because in those lower income years, you can convert money from your traditional IRA or 401k, where every dollar withdrawn will eventually be taxed at your future rate, into a Roth IRA, where it will grow and be withdrawn tax-free for the rest of your life, and for the life of whoever inherits it. You pay the tax now at the lower rate, so you never have to pay it again at a higher one. In retirement, where tax brackets can shift significantly once Social Security and required minimum distributions layer on top of each other, this conversion done in the quiet early years of retirement can mean the difference between a tax burden that slowly squeezes your portfolio and a tax situation that gives you real breathing room for the decades ahead. You do not have to convert everything. You convert up to the top of whatever tax bracket makes sense for your situation, carefully, strategically, but you do it while the window is open, because the window does not stay open forever. So let me pull all of this together, because I want you to leave this video with something you can actually hold on to. You are sitting at that kitchen table with the cold coffee and the retirement statement and the quiet realization that the game has changed. Here's what the game looks like now. You need growth to outlast inflation over a retirement that could last 30 years. You need stability to protect you from the catastrophic early losses that sequence of returns risk can cause. You need simplicity that holds together not just on a good calm Tuesday, but on the hardest days that life will inevitably bring. And you need tax intelligence to make sure that the pile you spent decades building does not get quietly eroded by a tax burden you could have managed with a few smart moves in the early years. The two-bucket strategy, a total market equity ETF paired with a high-quality bond ETF, automated, simplified enough to pass the spouse test, combined with strategic Roth conversions in your lower income years, addresses all four of those things without requiring you to be a financial expert, without requiring you to pay someone a fortune to manage complexity you did not need in the first place, without requiring you to watch the market every morning over your coffee. The best retirement strategy is not the most sophisticated one. It is the one you actually understand, the one you will actually stick to, the one that will actually work on the days when you are not at your best. Because retirement is long, and life is unpredictable, and the portfolio that serves you is the one built for real life, not for perfect conditions. People think a successful retirement is about the biggest number you can accumulate. And yes, the number matters, but what I hear from people who are actually living it well is something quieter. They say they wake up in the morning and the money is not the first thing they think about. They say they feel like they have options. They say there is more oxygen in the room than there used to be. That is what this is really about. Not outperforming an index, not impressing anyone, just building a structure that holds, that lasts, that does not require your constant attention to survive. That lets you be present for the life you spent 40 years working toward. If this video gave you something real today, subscribe to David Marshall Finance right now, because we put out content every week that gets into the psychology and the strategy behind the money decisions that actually shape your life. Like this video if it helped, and leave a comment below telling me where you are in this journey. Are you approaching retirement and trying to figure out the structure? Are you already in it and rethinking your setup? Tell me below. I read every single one. I will see you in the next video.